Welcome to the current federal tax developments here for the week of August the 21st, 2017. This week, we're going to take a look at a number of developments, one of which is a birth certificate that did not establish the taxpayer's age for tax purposes, a taxpayer who lost deductions for employee business expenses because he failed to ask for reimbursement from his employer. The Fifth Circuit, trying not to break from the Fourth Circuit, carves out a facts and circumstances exception to being able to substitute parcels in a donation of a conservation easement. We have a case where a taxpayer tried every way he could think of to argue why the amount he paid to the underwriter for commissions for selling stock in his employer's IPO should allow him an ordinary deduction for the ones that were created when he had to exercise his options and immediately sell, rather than getting a capital loss. And the IRS gave bad news this week to colleges, telling them that there'll be no more extensions of time to get the 1098-T reporting correct per the PATH Act and put the amounts paid rather than the amounts billed on the 1098-Ts. Well, this, as always, is brought to you by the Loscalzo Institute, a Kaplan Company, and by your state CPA societies. We have a lot of dates coming up here through the rest of the year in well over half the states in the country. So if you're somewhere, pretty much you probably can find either courses on either tax or accounting and auditing being given by one of our instructors. I'm going to be all over the place this year, including doing conferences in Minnesota, Oklahoma, New Mexico, and Arizona, along with full-day courses all around the country the rest of the year, the rest of the time. It goes all the way through February that I'll be doing sessions. So if you have some coming up, especially as we now get down, I realize everybody's putting their heads down now and is starting to, gear up for having to do those partnership returns on September 15th, the trust returns on September 30th, and the individual returns on October 16th. When you get your head up from those and you start looking for courses here through the rest of the year, be sure to consider what your state society offers and be sure to check for our courses in those catalogs. Let's go ahead and start talking then about the cases this week. And the first case is Omala versus Commissioner. This is a tax court summary opinion, 2017-64. The case was issued on August the 16th. And this is a case of a taxpayer who took a distribution from an IRA. Now, in reality, he hadn't reported that on the return at all, but by the time he got to court, he was agreeable that the IRA distributions represented taxable income to him. But the bigger problem he had was that he wanted to escape the 10% additional tax on premature distributions. The catch was his driver's license, the application for naturalization that he filed, and a bunch of other forms all gave a date of birth that put him just under age 59 and a half for the year in question. That's a problem because obviously if he's below age 59 and a half, then he's going to have to pay this extra 10% tax. Well, the court, interestingly enough, quoted Helen Hayes in the decision, who the court cited as saying that age only matters if you're cheese. But as the court noted, in this case, age also matters for tax law. Now, he had to deal with this, so he went to Kenya, which is where he was from, and he got a birth certificate. That birth certificate had a date of birth that showed he would be over age 59 and a half when he got the distribution, and that would have allowed him to escape the 10% penalty. The problem was, though, that he had obtained this birth certificate from the agency. There was no question it was legitimate, but the agency didn't have any records of his date of birth, so they asked him for his date of birth. And of course, he provided that date that was the one date on any document that would establish he was over age 59 and a half. As you might guess, the IRS argued, wait a minute, that document from Kenya doesn't really prove anything, because the date was they just simply took his date and put it on the birth certificate. The tax court agreed. The tax court said, well, here's the catch. We're not actually going to say you're lying, but we're also not going to say that, this is anything more than your own testimony. We have no independent evidence that you are over age 59 and a half. Missing that, you have failed to prove that the IRS was improperly assessing the 10% tax. So because of that, the court said, you have failed to carry your burden. Therefore, the 10% tax is due. Next up, another case we've got here for tax court summary opinion. This is Howard versus Commissioner. This is tax court summary opinion 2017-65. It was issued on August the 17th of this year. In this case, the taxpayer claimed deductions for employee business expenses that he had paid during the year. Now, as we should all know, employees are in a trade or business, so if they have ordinary and necessary expenses, they're deductible. That part is fine. But the catch is, one of the problems that we've had lots of case law to back this up, is the expense is not really considered necessary if, in fact, the employee has the ability to get the expense reimbursed by the employer. It may be ordinary, but it's not necessary for the employee to have incurred the expense because the employer was willing to reimburse. This particular taxpayer, though, did not submit for reimbursement, and he argued the reimbursement policy of the employer was actually before the court. He argued that the reimbursement policy, as he interpreted it, would not allow him to be reimbursed for the items he was claiming deductions for. And the amount of deductions he was claiming kept increasing every year. The tax court, though, read this particular reimbursement policy, and to be honest, as they summarized it, it appeared it was ambiguous whether or not there would have been a problem with the expenses he had submitted. The court noted he had submitted other expenses that had been reimbursed. He had no records of expenses that he had submitted that had been turned down for reimbursement, and the court found that he hadn't submitted evidence that, in fact, these weren't reimbursable, because arguably, at best, the reimbursement policy was, shall we say, not clear. And frankly, I think the court really determined that, probably the way it was written, that, yeah, he would have been able to be reimbursed. So since the court did not read the policy the way he did, the court found that you haven't yet proved you couldn't be reimbursed. Now, he could have proved that had he requested reimbursement and the company not given him the money. He also probably would have had a better shot had he gotten a letter from somebody in human resources, somebody other than, and preferably before the case came up, that stated that, yes, the policy should be interpreted the way he was interpreting it, and in fact, they applied it that way to other employees. The problem was he just had his word. What sometimes happens that I've noticed is you have a couple of issues that cause this to come up. Number one, a lot of people hate paperwork, and if there's something that's clearly paperwork, it's expense reports. So they don't get around to filling out expense reports for everything that they could have. Then at the end of the year, they notice that, oh, I didn't submit these expense reports because I missed the 60-day deadline for submitting them under the employer's policy, so I'm stuck. So then they come in and try to claim the deduction. There's the other half who believe, incorrectly, that they don't want it reimbursed because they want a deduction on their return. Those are the ones you have to explain. First thing is employee business expenses, so we're going to get the 2% haircut automatically. So we're going to lose 2% of adjusted gross income when we're going to take that against all of our miscellaneous deductions. Secondly, if they are subject to the AMT, these employee business expenses are going to be worthless because they're below the line. And most importantly, we do not yet have a greater than 100% tax rate. So if I'm able to deduct $100, at best, you're going to reduce my taxes by somewhere around 42, 43%. Maybe if you're in certain states, we can get up close to 50 in certain situations. But we're not going to get to the point where, in fact, you ended up actually making money by having the deduction. Had you just been reimbursed, you'd have $100 in your pocket. While if you're able to claim as a deduction, you're out, shall we say, 40 or 50 or more dollars. So it's always kind of interesting. Remember, if you're going to claim employee business expenses, your client has to be able to justify that the employer would not have reimbursed those. The safest way to do that is have them submit the claim and have it denied if it is at all unclear from the policy about whether or not they could be reimbursed. Next up, We have the Fifth Circuit reversing the tax court. This is BC Ranch 2 LP et al. Versus Commissioner. This is case number 16-60068 and 16-60069 from the Fifth Circuit on August 11th. We had actually discussed this case on a different issue last year when the case was first decided by the tax court. And in that case, the issue was a disguised sale question. Now, actually, the Fifth Circuit dealt with that here, and they did not totally reverse the tax court on that one. They partially, mainly because they concluded that the tax court had erroneously concluded that everything, that the partnership interest, what they paid for it, was equal to the value of the land. The Fifth Circuit decided how the tax court arrived at that wasn't quite right. They did agree there was a disguised sale, so that part of the analysis works. You may remember the case where they essentially got partnership interest, and then basically a few years later, they would get a parcel of land in exchange for giving up their interest. The court said, well, they got other things in the interim, so that wasn't it. And some of that did come from participation in the partnership. So tax court, you misspoke. There is a disguised sale, but only for a part of the proceeds, not for the whole. So they sent that back to the court. But this was another part of the case that became kind of irrelevant in many ways when the court decided that there was that disguised sale. But part of this transaction was also to claim a conservation easement. And in that part of the case, they contributed the property and they contributed a conservation easement on these areas they were going to be building home sites on. And what they would do is they would lay out this area. They would carve out certain 5-acre sections on which they would put homes. And then the rest of it would be preserved as natural, in its natural state. Per the terms of the easement, they could, however, request from the charity the right to, let's say that we find that this particular property for the home site, we would prefer to move it slightly, maybe to protect a piece of that for the neighbors, and so give them other land. So it was set up in theory that they could redo it if it advanced the conservation objective of the entity. But what that would mean is, of course, that some of the land that at donation had been preserved and protected would become unprotected if that particular provision ever was actually implemented. The taxpayer said, well, really it is permanent. They're giving it, we're giving it to them for life, and it's protected, and it makes the conservation project work better even. But the tax court said there's a problem. There was a case a number of years earlier. The case is the Belk case. In the Belk case, the taxpayer had given a similar conservation easement, but again reserved the right to take some of the property out, or at least to ask to take some of the property out, as long as they were willing to put in an equivalent amount of property. And that case, the tax court decided that was not preserved in perpetuity, and that case was appealed to the Fourth Circuit, who backed him up. The tax court said, well, this is just Belk all over again. Therefore, you didn't preserve the easement in perpetuity. And because of that, there cannot be a conservation easement issue here because that's gone. 2 of the 3 judges on the panel disagreed with that. They argued that this could be distinguished from Belk. That in the Belk case, they could take a totally unrelated parcel that wasn't anywhere in the area that had been originally donated, and they could substitute that. And that opened up a lot of issues, including what the valuation was, because this other piece of land could be very different, and simply allowed them to pretty much, claim it and then maybe never really give any of that land. The majority said this is different because we were merely talking about moving home sites. And so the same basic area would be protected as well. They could only do it if it advanced the conservation purpose of the donation. So they felt that was different than Belk, and they said the tax court was wrong to reject it on the Belk case. However, there is a dissent on this issue, not on any other issue in the case, but on this issue. The dissent said, oh, come off it. There's no real difference between this and Belk. You could radically change the nature of what was given by being able to substitute parcels of land. That could also change the proper valuation, because it's one thing if we know these parcels are never going to be touched, but now you're going to have potentially totally different parcels that you thought were home sites that won't be home sites, and other parcels now that will become home sites to take that land out. So he said, this is no different than Belk. And because they didn't preserve it in perpetuity, the fact that it's in the same basic area, that's in the same big area that we're dealing with, makes no difference whatsoever. And the court should not have reversed on that issue. And they should have said, yeah, everything else, yeah, we're reversing on the partnership, reversing on the valuation issue, but we're not going to reverse on this particular donation. That was the view of the dissent. That leaves us with a problem. Where do we stand now? Well, practical matter is it's still going to be extremely risky to have such a provision in an easement if you're making a charitable contribution deduction for a conservation easement. If your client, unless there is some really compelling reason why your client absolutely has to maintain this right, and your client's willing to risk losing the whole thing and have very upset IRS at them, because conservation easements, as you probably noticed, have been listening to this for a while. We have a lot of cases on this, so the IRS goes after these. If they're willing to do all that, then yeah, maybe you could do it. But generally, if at all, you want to try to make sure that you preserve the easement, so any land that was in the easement is always in the easement, and there won't be a problem with it. If your client does say, I want to do it, the question is, what can we take from this case? Well, even if we interpret this case, very, very much, in favor of taxpayers and try to apply it, you do have to realize that all it really did was carved out a facts and circumstances exception to the Belk decision. And you'd have to worry about what exactly do you have to do to meet the requirements to be different from Belk. Is it okay? Is it just having to be in the same big plot of land? Or do we have to do something different? Is it okay if we do or don't have the conservation issue? Is the conservation issue really the big thing? If it has advanced conservation purpose, and could we use outside land? It's not clear from this, except that there would appear to be, in the view of the majority, some line below which it's okay. Your ability to substitute is not a problem, but they still admit, because they didn't claim that Belk was decided wrong, that there is a limitation after which you're going to lose it. So be very careful going very far with this case. I certainly would not expect the IRS to follow this case outside the Fifth Circuit. And I would expect they would continue to push the position that if you have a right to substitute property of any sort, even though it's at the charity has to consent, and even though you claim they have to determine that it's a better piece of property than otherwise, you got to be really careful, and you have to understand the chances are really good that you're not going to be successful if you try to raise that position. So, just be a little bit aware of that. Next up, we're going to go ahead and take a look at the case, in this case, of Hahn versus United States. This is a case from the Court of Federal Claims. It's case number 15-20T. The decision was handed down on the 16th of this month. And this deals with a taxpayer who was an employee that had been offered non-qualified stock options, and he was an executive in a non-publicly traded company initially. Now, there were other shareholders who held much bigger, who held large interest. So even if he exercised all of his options, he still would not hold a huge interest in the company. However, now they're going to have an initial public offering. So, the company's going public. They offered all of the employees who had stock options, who had stock or stock options, the right to participate in the IPO. But if they did so, they had to meet certain conditions. One of those conditions was that they had to basically exercise all of their vested options and then dispose of the same percentage of their now total interest in the company as the major shareholders were disposing of in the IPO. If they didn't participate in the IPO, Obviously, they could still exercise the stock options, but the problem would be then there's a 180-day lockup period during which they could not sell their shares. And as you're probably aware, if you followed IPOs, a lot happens in the first 6 months. And in many cases, there's great excitement when a company goes public. And then that excitement dies off over the first 6 months. So having to wait 6 months really puts you at risk of getting much less for the stock than you'd get if you participate in the IPO. But if you participate in the IPO, here's the problem. He's going to have a same-day sale of stock, and he's going to be charged the underwriter's commission on the sale. Now, what happens there is we really have, in the view of the IRS and in the view of almost everybody, normally in such a transaction, you have two different transactions. Transaction one is the exercise of a non-qualified stock option. In that case, the taxpayer recognizes as income the difference between the fair value of the stock on the day at the time of exercise and whatever they had to pay as the exercise price or strike price. Quite often, they do this in what's called a cashless form. When you do that, you don't actually put the strike price in, but rather a number of shares equal to the strike price are sold to pay your option exercise price. Similarly, in most cases, you're going to have to also sell a bunch of shares to deal with the federal tax withholding and FICA withholding that's required on this. And because, quite honestly, you now have something that's valued at fair value, and you can sell it and convert to cash, which can get you from being so heavily concentrated in your employer stock, and your employer also put you on salary. So you have a lot invested in the employer, and maybe you'd like to diversify some. In many cases, we have a same-day sale of all the shares, and that's what was going to happen here, obviously, for the IPO shares, because that was all points, trying to get cash. But the problem with that is you recognize, so your basis in the shares is, let's say, $150,000. Let's say you pay a $10,000 commission. Well, the problem is going to be the fair value is 150, so that's your basis. But what you're going to get is 150 less 10,000 cost of sales, which is 140. So you're going to have a $10,000 capital loss. Of course, the problem is if you don't have capital gains, you're only going to get a claim 3,000 of that capital loss this year, and the rest is going to go forward. That was the problem here with somewhat bigger numbers. So he was trying to figure out, he argued that, wait, that really shouldn't work that way. He said, really, I should just pay tax on the net value of what I'm going to receive. So he tried to argue a number of ways that he should either get an ordinary loss, or the amount thrown in his W-2 should be reduced by those commissions. He argued that, first, under the agreement to participate in the IPO, he had no option but to exercise all of his stock and then immediately sell a portion of them and get charged a commission. So his claim was he never actually received the stock or the value for any of that. So effectively, he shouldn't be treated as having a stock price of, let's say, $15, but he should be treated as having a stock price of $15 less the commission on each share. And that's really what he got. And that's reality. He didn't really have two transactions. The problem that we have with this, to a large extent, in that theory was, it's only because he wanted to participate in the IPO that he ended up with a single transaction. Nothing stopped him from exercising his options and just holding them, right? Except for the fact, of course, that he didn't want to hold them and have the chance of going down. So the court said, no, we participated. You still basically had two transactions. Now, so he said, well, okay, different view then. Well, the amount of the commissions then really are an additional strike price, because, again, still going with this single transaction, in order to exercise, if I exercise those options, I had to sell the stock. And therefore, that's a cost of exercise. So that should be considered part of my strike price rather than be considered part of the, a separate capital loss. So it should net out, right? And what I received was less, or we should be able to treat it as additional costs paid under the stock and acquisition cost of the stock. So in either case, we should be able to net that down and the amount of my W-2 should be less because my W-2 amount would be the difference between the fair value and what I paid. And since that's true, I shouldn't have to pick up as much of a spread. That netting should come out in W-2. The court rejected that as well because they said you didn't have to pay a commission to exercise those options. You had to pay a commission to sell those options. And that's your problem. This is a part of the sales transaction, which makes it a capital issue, not an issue for the original exercise that would treat it as something that would be used to compute what's in your W-2. You tried a final one. Hey, maybe it's an ordinary and necessary trade or business deduction. Again, this wouldn't work as well because it would be on a 2106. He'd have the 2% haircut. He would have the fact it wouldn't be deductible for AMT, but at least he gets something better than a $3,000 deduction, very possibly. Well, unfortunately, the court said if you're both an employee and a shareholder, you have to carefully consider with each transaction which hat you're wearing. And this transaction, he was wearing the hat of a shareholder, not the hat of an employee. Therefore, this was all part of his sale of the investment security. And ladies and gentlemen, it's a capital loss. So by the time we're done, the court rejected all of his theories. And he was stuck with that capital loss, most of which he could not recover in the year he exercised the options. Finally, this week, we're going to talk about a little issue that came out in Tax Notes Today this week. The Tax Notes Today on the 15th of August published an article where they mentioned that the colleges and universities have been told they will not get an additional extension of relief for how they have to report Form 1098-Ts in the future. If you may remember, the PATH Act added a requirement that educational institutions had to, on a Form 1098-T, report the amount of tuition paid, not the amount that was billed. Previously, they could report either billed or paid. The ability to use billed was being pulled. Now, colleges and universities screamed at that point that that'll be too complicated. They need more time. The IRS issued an announcement early in 2016 that said, okay, you don't need to do this for the 2016 1098-Ts. And then late in 2016, they issued another announcement that said, okay, because the colleges said, well, this is still too complicated. We need more time. So they said again, okay, you don't need to do it for 2017. Tax analysts reported this week in an article in Tax Notes that the National Association of College and University Officers, the NACUBO, and that should be business officers, had been told by the IRS that, gang, this is it. No more extensions of time will be offered. So this means that Form 1098-Ts will have to show tuition paid on 2018 forms filed in January. We're still going to have the same problem this year that 2017 1098-Ts can show billed, and quite a few of them will show billed rather than paid. But in 2019, it'll be the amount paid, which for those of you who are preparers is actually a good thing to happen, because you remember that we are now subject to the rules that require us to exercise due diligence whenever the American Opportunity Credit is claimed. And one of the things we're going to have to prove that we did is we made the proper inquiries for how much was paid for that year, because it's based on the amount paid is what you claim the credit on. The good news is now the 1098-T will give us evidence of amount paid. But for 2017 returns, you're still going to have to ask the client for other evidence of what was paid, because the amount showed on the 1098-T, unless it is clearly the amount paid, is not necessarily something that can be used to compute the American Opportunity Tax Credit. So bad news if you're having to prepare 1098s for colleges and universities, but for the rest of us, probably it's good news. Well, as I reminded you at the beginning of this broadcast, be sure to check out your CPE from all your state societies here through the end of the year. That's going to be triply true if we actually do get comprehensive tax reform, because all of us are watching and planning to try to do something if in fact comprehensive reform comes down. So keep your eyes open. And by the way, stay tuned into this broadcast for information on what would be happening if we actually do get that comprehensive reform. But there are lots of other options offered at your state society's website. Right now, while you still have some time before everything gets really hectic, you might go ahead and take a look and see what courses you'd like to pick up here after the 15th of October and before everything really revs up and we go crazy through the end of the year. This has been the Current Federal Tax Developments for the week of August the 21st, 2017. You can catch our daily updates, or our updates through the week, not necessarily daily, at currentfederaltaxdevelopments.com. You can also download a PDF that has articles that describe in more detail all the things I talked about today. If you have any questions or comments, you can send them to me, Ed Zollars at currentfederaltaxdevelopments.com. You can also follow me on Twitter at Ed Zollars is where you follow. As I post articles to the website, I will tweet them out on Twitter so you can read them there and follow them, read the article if you want to at that time. Well, hopefully, it's still August, so probably we'll still be looking at court cases, and obviously Congress is not back, and that's going to be interesting. But we still expect to have enough developments to keep us busy for the next week. So be sure to join us back here next week again when we again discuss the current federal tax developments for the upcoming week in taxes.